Good morning, ladies and gentlemen. How's it going? Welcome to Friday. We made it. End of the week. Let's make good decisions. Ended on a high note. Hope everybody's doing well today. It's good to have you guys in here. Today will be a short classroom today, guys. We're going to shut it down by 11. Got a road trip to take down to the mothership in Sarasota. So we're going to get on it, get into it. I'm excited. I love Fridays. Fridays are great. Here's your reminder, guys. This is an educational room. I am, and I love it, Tesla. I am an educational guy. I'm a guy that's going to help you um, learn to read your indicators. That's kind of my whole job description. But before we get to the good stuff, guys, today is Friday, January 16th. It is 9:15 a.m. on the news release, and it's low impact, so we're not really stressing about it. One of the things that I do every morning, and this is part of my advantages, and everything that I do revolves around advantages. Everything that I teach revolves around advantages, to be honest. Knowing when there is a potential news release, it allows you to sidestep the challenges of emotional responses from the people in charge. That's really what it is. So nothing going on, but we do go to forexfactory.com/calendar if you are one of my Ninja or Nexgen Pro Trader funding people. One of the biggest rules for your semi-live accounts is absolutely no red flag news trading. So work this into your habits. Make sure that you don't make that mistake. There is nothing worse than losing an account because you didn't check news. And then we're going to get going here. Whoops. I say whoops. You guys have absolutely no idea why. My slideshow came up on the wrong monitor again today. I don't know why. What we're going to do, there it is we're going to work together, guys. You guys are going to talk. I'm going to listen. I'm going to talk. You're going to listen. We're going to have a discussion. We're going to try and keep this from being a lecture. I'm going to zip through a little bit. I'm not gonna pause for effect as much as I usually do. The whole goal in this room, the whole goal when you acquire the T3 indicators is to learn how to read them, guys, to be able to look at them, to recognize advantages, to turn those advantages into trades. And what you're going to find is that the majority of your day is not trading. About 90% of your day is reading your charts, waiting for something to happen that you can prove wins more than it loses. Active trading is about 10% of your day if you're doing it right. If you find yourself at 75 trades at 9:30 in the morning, you're probably over trading, to be honest. You're going to understand through your chart reading where the market is likely to continue to go and to stop. These three concepts. Hey, congratulations, Tesla. Welcome to the big leagues. The concepts of where the market is likely to continue, where it's likely to go, and where it's likely to stop are really going to be ways to enter, to manage, and then to relax. And to illustrate that, this is what the market does. I'm not going to try to sound smart, guys. There's just no hope for that. The market goes up and the market goes down. That's what it does all day long. So there's only three things you can do. You can buy the market when it's going up, hope to make some profits. You can sell the market when it's going down, hope to make some profits. Or you can wait when you just don't seem to have an edge. Every time a trend gets established, well, I won't say every time. Usually, the market's going up, everything is wonderful, and then there's just a little bit of down, a little push, little fight. Market's going down, there's a little push up, guys. The methodology that we're going to talk about today, the high probability, I can't talk, the high probability trend trade is really nothing more than a way to pinpoint right where that fight is most likely to be lost. That becomes your entry. That's where the market is most likely to continue. When you take this high probability trend trade, very often you will use key areas in the distance for targets. That's where the market is likely to go. And if the market has already reached one of those areas, you're going to say, wow, that's something that could stop the market. I choose not to take the next trade. That's that likely to stop area. We are going to learn these three concepts. And we're going to do it with only 3 rules on 2 charts. And the first 45 minutes or so of this room is going to be learning the rules, guys. Whether you're on NinjaTrader or TradingView, learning the rules. Whether you like big moves or little moves, learn the rules. Because the rules describe a pattern, and that pattern can be proven to win more than it loses. That's why you take the trade. You have an advantage. You have an edge. And then we just let probabilities work themselves out. Everyone in the room can simulate. You don't have to be on live money to learn something new, right? You don't have to jump into the center of the ocean to learn to swim, guys. Wade in from the shallow end. Simulate, practice, focus on the rules, and then post them in the room. Every time you post in my room, we have a conversation. Every time you post in my room, it's like a private session. You see John Novak's in here today. So very often when you post in my room and he's around, you get a private session from him too. He loves to give feedback on the trades that you guys are taking. Guys, the feedback will help you identify the things that you're doing well. It'll help you identify where there may be challenges, flaws in your chart read. And when we identify challenges, we don't just say, dag nabbit, Victor, you screwed it up. Go do better, right? Do better. We say, hey, this is what happened. Here it is. Do you see it? Okay, now here's how you fix it. Posting in the room is how you're going to get to where you want to be the fastest. And it's scary at first. I know that. If you're shy, just post a picture of your puppy in the room, right? Get used to it. Get that good reaction because you were the last person at the bottom. And then the second thing is simplify. I've actually had people tell me that our methodology isn't complex enough to be effective. And I'm going to disagree wholeheartedly, guys. And I'm going to hand you a plan, whether it is NinjaTrader, it's the KISS plan, or whether it's TradingView, it's the KISS plan. And the keep it simple plan, guys. I teach from this place of simplicity. And the plan that I hand you, the plan that if you choose to, you can follow as a brand new user, you can follow it as an experienced user. This plan is a stepping stone in your learning journey. It's just like the beginning, the foundation, the groundwork. It's designed to teach you how to read your indicators so that you can recognize advantages so you never wonder what's going good for you or what's going bad for you. The trades in this plan are designed to optimize your chances of success, to give you the highest probability as you begin your journey with Nexgen, because confidence comes from the memory of success. And we want you to feel confident and comfortable and trust that this is a plan that wins more than it loses. And then through study, through simulation, through class feedback and practice, you're going to write your own plan. Seems like everybody does. And that's exactly what I want. I want you to be so good at your chart reading that you fire me and you go just find your success for decades to come. So simplicity is the cornerstone of what we do. We're going to focus on one trade. Going to learn to do that trade really well. We're going to make it second nature. And then if you really feel like it's not enough, there's more opportunity. So post in the room and guys, track your progress. Take pictures, annotate charts, go back and study those charts. Make sure that you're not repeating mistakes. In order to take a high probability trend trade, we're going to start with NinjaTrader. It's only 3 rules. That's it. 3 rules. When a rule is true, it creates an advantage. It is the 3 advantages that is a trade. A trade is not your desire to get rich. And entering the market shouldn't be based on your need to pay the mortgage, right? A trade is momentum through rule number 1. It's a clear path, room to profit targets through rule number 2. And then it's defining the perfect entry area where that fight against the trend is most likely to be lost. These 3 rules, very simple, learn them individually, piece them together to create a trade, happen on 2 charts. There's a big chart and a little chart. That's pretty technical. The large chart is a very slow-moving chart, guys. It's a very broad stroke of a brush. It shows the overall opinion of the market. It lets you know what's happening and what's happening right now. You'll use the most current bar, the first printing bar on the large chart. It'll define direction. It'll define momentum. It'll define areas. Your first 2 rules, your first 2 advantages are met right on this bar. When they are met, you'll turn your attention to a smaller chart, a faster chart. This is your refinement chart. This is going to pinpoint right where that little fight against the trend is most likely to be lost. That becomes your entry for the highest probability trend trade. That's going to allow you to reduce risk, and it's going to get you into the market as far as possible from your profit targets. So it'll increase profitability. 3 rules, 2 charts. And we use the 2 chart concept because it's very humbling, but it's very factual. You are not in charge. So it's imperative that you know who you're trading with and who you're trading against. When you are trading with the trend and with the momentum and there's nothing in the way, guys, you're with a large crowd. These are the men and women with the money and the influence to create those trends, to establish that momentum. They react at those areas, and the large crowd typically wins. Now, if you're following the first 2 rules, that puts you in line with a large chart. Your small crowd, the small chart, the small crowd, they create the fight. They create the retracement, that tiny push counter to the underlying trend. Your 3rd rule is designed to pinpoint right where their failure is imminent. And when the large chart rules are met, the small crowd typically loses 70 to 80% of the time. This methodology gives you the potential to win up to 70 to 80% of the time. That's that confidence that comes through the memory of success. We're going to use areas in most of what we do. Areas are horizontal lines on a chart. There's math that goes into them. There's algorithms that take place. There's different indicators that come together behind the scenes to create these pretty lines. What I want you to take away from this is that lines can create bounces. Whether they are on the big chart or the small chart, areas are bouncy. You're going to see divergence highs, Fibonacci resistance. You're going to see Fibonacci support, divergence lows, and yellow 1-to-1s. In an uptrend, a yellow 1-to-1, a divergence high, or a red fib can all behave as resistance. So we can blanket term it areas of resistance. In a downtrend, divergence lows, blue fibs, yellow 1-to-1s can all behave as support. So we're just going to blanket term it. The market is reaching an area of support. So support and resistance will help you determine where the market is likely to go. Support and resistance will also help you determine where the market is likely to stop. Support and resistance will help you define right where the market is most likely to continue. Areas show up in pretty much everything. Trigger lines do the same. And guys, all you need to know is that these are small, 2 solid lines. Green is up, red is down. These are large, small and large. Large will be dashed. Green is up, red is down. These trigger lines are moving averages. You don't have to know the inputs. If you can remember small and large, you will use these triggers to define the momentum in the market, making sure that rule number 1 is met. You will compare those bouncy lines to these trigger lines to make sure that you're not trading directly in determination conditions, and you will define your amazing show-stopping entries right at those large trigger lines on a smaller, faster chart. Trigger lines do 90% of the work. Let's learn to read trigger lines. And we're going to start strong triggers. That's rule number 1. Rule number 1 is actually number 1 for a reason, guys, because when rule number 1 is met, you have the advantage of momentum. And momentum is very difficult to stop when you see it on a large chart. So strong trigger lines on a large chart lead the way. When the background is green, the trend is up. When the background is red, the trend is down. Path of least resistance has you looking for rules to be met for high probability trend trades in the direction of the trend. How could you take a trend trade without it? Strong triggers is one look. It's very black and white for the new user. I would love it if you guys allow it to be. Not everybody has that level of restraint. In an uptrend, the small triggers will be green. In an uptrend, the large triggers must be green, and your small triggers will break above and away from your large triggers. It looks very much like scissors that have opened. And when the scissors are open, when the space is there, the odds are favorable for the market to continue up. When you're in a downtrend, the small triggers must be red, the large triggers must be red. Once again, there will be space between the small and large, I'm getting pretty good at drawing scissors. When your scissors are open, the odds are favorable for the market to continue down. I love that phrase, odds favorable. That phrase puts a big old honking smile on my face. Odds favorable. It's going to be tough to stop. This is the look that helps break areas. This is the look where we're relying on it to sell areas of resistance to continue with that momentum, where we're looking to buy areas of support to go with all that goodness. Guys, strong triggers lead the way because strong triggers are hard to stop. When your scissors close, when your small triggers return to the large triggers, we call this weakness, which happens to be the opposite of strong. When I have weakness, anything can happen up or down. With weakness, very often you'll see retracements coming out of the middle of nowhere. When you see weakness, very often you'll see key Fibonacci areas are most likely to hold. So if we just happen to open up a large chart, you would see no separation right at the top, and sure enough, the market pushes down. And you would see that separation as the market's going up, and sure enough, it's breaking key Fibonacci areas. And down here, weakness begins to pull back. Colors don't match. There is no momentum, and you can see how the market waffles. And it's just trying to find its way. Our job is to be patient until they do. And you guys will probably begin to recognize these tails as potential entries on a smaller, faster chart. So can you guys give me a Y in the room if you're with me? Separation is strength. When you have strength, that market's going to be tough to stop, guys. I'm going to tell you right now, rule number one, God bless it. It covers up some of the mistakes that we make as new users, because we might accidentally trade into things, but with all that momentum, we get away with it every now and then. Rule number two are the things, right? Rule number two are termination conditions, areas that could stop the market, things that will tell you you don't have room to profit targets. If a termination condition is present, you don't have a clear path. The recipe for a trade says that that's exactly what I need. So let's define a termination condition. You know what? I haven't done this in a while. Let's go to the wordy technical version of what a termination condition is. And I'm going to show you how simple it can be. Actually, I love this definition, but a termination condition is a Fibonacci-based indicator that may reverse the market. And it's based on a comparison of the triggers and the area. That's a lot to think about. So I'm going to simplify it. You ready? What's a termination condition? It could be an area on the big chart. How's that for easy? If you get to a line on a big chart, it could stop the market. If you get to a line on the big chart, that's exactly where the large crowd is most likely to make their decisions. That's where buyers buy, and that's where sellers sell, and that's where fights happen between the two forces. So the whole goal of termination conditions is to keep you out of that decision-making process. Let them fight it out, and then when a winner is declared, we're going to get behind them and be on their side. So to define a termination condition, the first thing that must happen, has to happen, it's imperative that it happens, is that price reaches resistance. Remember, resistance is a blanket term. It can be a divergence high, yellow 1-to-1, or red Fibonacci resistance. Or the other direction, price reaches support. So when price reaches the area, it sets off the decision-making process of the large crowd. The buyers are like, oh, maybe we want to ditch the effort. And the sellers are like, maybe we want to enter the effort. And the buyers and sellers might say, well, I want to go up and I want to go down. Let's just fight for a minute and drain Mark's account if he decides to trade. So when price reaches the area, we're done with price. The decisions are being made. We're just going to go to the trigger lines to tell us the story. And it really is pretty simple if you learn to count triggers. If none of your triggers have broken above resistance, resistance is a textbook termination condition, and rule number 2 is not met. You do not have a clear path. If price reaches Fibonacci support and all 4 trigger lines remain above that area of support, not price bars, but the triggers, That's an area that is a termination condition. That termination will do one of three things. That termination could reverse the market completely, making it a strong top or bottom, which is a great thing because very often there's bigger moves the other direction when that happens. This area of resistance, the sellers might try to take over, the buyers might tell them no, the sellers may say yes, the buyers might say no, yes, no, and then one of them will win. We don't know which one. This is a fight that you don't have to get caught up in. Or that area just breaks, smashes right through. You'll never know what the reaction's going to be. That's the cool thing about what we do. You don't have to know what the market's going to do to make money in it. Learn some simple patterns. Price reaches, no triggers, no trade. It's a termination. If it doesn't reverse or start a fight, it means it's breaking. This is what it looks like when it breaks. First, number one, price reaches support. All the triggers are still above, 0 triggers through, absolutely no trades. Wait for the reaction. Kick back, relax, sip your tea, enjoy life. You don't have to predict. If the small triggers absolutely smash through that area, you have all the momentum from rule number one. This area does in fact have the potential to break, but it's not a clear path yet. Rule number two is still not met. This is going to be where you find your first medium probability trade. A trade where most of your indicators line up. However, that one small issue exists. The path isn't clear. You'll be able to take these trades, you'll be able to manage these trades assertively, getting to a 0 loss level quickly because it's not the perfect trade yet. Once all 4 trigger lines, both small, both large, get south of support, support is broken. It begins to behave as resistance. Your path is now clear, and your path remains clear until you reach the next area. So let's go take a look. Weak triggers at resistance. That's where the bounce comes from. Price reaches Fibonacci support. Remember, we're looking to the triggers, not the price bars. Only one line of the small triggers ever get through before it retraces all the way back to resistance that used to be support. And that's where the market continues down. And let's see, they stop damn near to the tick at Fibonacci support, and this is where the market appears to be bouncing up. Resistance breaks, becomes support. That's probably a great entry. Divergence lows, Fibonacci support, Fibonacci resistance, one-to-ones. All of these areas can create a bounce. Your job is to learn to respect them because 60% of the time they work every time. All you have to do, and this is your cheat sheet, all you have to do is count triggers. Price reaches a line, 0 triggers through, it's bright red, no trades. Sit on your hands, do nothing if you're following the KISS plan, because more often than not, it's going to create a loser. 2 triggers smash through with momentum. It's still red. Yes, the potential is there, but guys, the plan that I hand you is designed to optimize your chances of success. It's going to keep you a little patient, and you're going to wait for 3 of the trigger lines to get through the area, and it's still only yellow. Caution. Manage assertively. Take quicker profits, get to break even because it's still not the perfect trade. When 4 triggers, 1, 2, 3, 4, get north of resistance, resistance becomes support, the path is clear, the golden goose is being served in front of you guys. This is your absolute best look for the highest probability trend trade long. There will be times. There will be times when your path isn't clear because there's multiple areas. There will be times where your path isn't clear because every time you see the potential, it hits another line and you go right back to number one. This is okay. This is 90% of your day, guys. The futures markets trade approximately, they exchange about $220 billion hourly. Most of you S&P traders are trading a market that exchanges somewhere around $175 million a day. It takes $400 a day to become a 6-figure trader. So you don't have to be the first one in or the last one out. You don't have to be in every move. Every tick doesn't belong to you. We're going to use the idea of momentum and path. Whether an area breaks and we have momentum, we're going to pinpoint the fight on a smaller, faster chart. When there's momentum and room to trouble, we're going to pinpoint the fight on a smaller, faster chart. The easiest trades you will ever take will have momentum and path and then a clearly defined entry. So clearly defined that you'll use a limit order to buy or sell a pullback in an area inside of triggers. Guys, that's defining the point where the small crowd is most likely to lose their fight. That is the exact location where the market is most likely to bounce and continue in the direction of the trend. I'm a language nerd, I'm not going to lie. This is the most important phrase you will ever learn in regards to entries. I'm going to give you the PowerPoint right now because this picture's in there. I want you to cut it out and I want you to paste it to your mirror. And every morning when you're brushing your teeth, I want you to read it out loud 7 times. You will know exactly where your entries come from before the market ever gets there. You're going to use a limit order, waiting for the market to get to your entry. And you will buy or sell a pullback. And that pullback is that small push against the trend. And it'll start with a reversal bar. That signals the beginning of the pullback. And you're going to do it at an area because does everyone remember areas are bouncy? Probably drives my brother nuts when I say that. Areas are bouncy. Lines are bouncy. So we're going to use Fibonacci support or resistance, yellow 1-to-1s, or a midband. And these are going to be the areas where the market is most likely to ricochet and continue in the direction of the underlying trend as long as those areas are inside of triggers. Those large triggers are going to show you where the areas need to be. They're going to call your shots for you. So this entry phrase, use a limit order to buy or sell a pullback at an area inside of triggers. Learn it, recite it, and it looks exactly like this every time you take a long trade. It's a pattern. It's a repeatable pattern. It's a testable pattern. It's a provable pattern. When everything says up, when the large chart is green, when the triggers are strong, when the path is clear, your fear of missing out is going to be hitting you full tilt boogie. Oh my gosh, the market's going without us. I thought I was going to take a trend trade. Mark Novak is a loser. This is snake oil. And then the reversal bar prints. And the reversal bar signals the beginning of the pullback. It's the beginning of the fight. It's not your entry. But it says, hey, you know what? The opposing forces have arrived. Let's go define precisely where they are most likely to take that fight. Somewhere from the top to the bottom of those large trigger lines. Now there's 2 sets of trigger lines on your small chart. They're large chart, small chart. They are equal. They are equally as important. One is not more important than the other. It doesn't matter if the line is in the synthetic from the large chart or if the line is in the large from the small chart. This range is where the market is most likely to retrace because price returns to moving averages. It's called regression of the mean. Trigger lines aren't bouncy. That's not your entry. Entries come from fibs, midbands, or yellow 1-to-1s inside of the retracement zone. And it could go from the midband up here towards the top. It could also go from the yellow 1-to-1s that are a little bit lower. It could also blow through everything and run you right over. You'll never know what the outcome is going to be, but if you set your limit order just above the highest point of support, if you wait for the retracement, this is your highest probability trend trade entry. This is an entry, when coupled with momentum and path, typically wins 70 to 80% of the time. So this pattern creates an edge. This pattern gives you an advantage. This pattern has no predictability on whether it will win or lose. But if you take it 10 times, you're likely to win 7 or 8 of them. A little good management goes a long way. Great entries create manageable trades. This is my favorite part about the entry rules. Sounds silly, but my favorite thing about the entry rules is that by learning where the market is most likely to continue, you have actually defined exactly, whoops, that's the wrong picture, where the market should not go. If this is going to be one of those 70 to 80% winners in the short, it shouldn't make it 4 or 5 ticks beyond those triggers, guys, because that's beyond the retracement zone. That's beyond the areas that are likely to stop the market. That's where the advantage is gone. You will be willing to take a loss at that area. You won't sweat it when the rules are met because you know that's the look that typically wins more than it loses. By defining where the market is likely to continue, you're able to minimize your risk. Same thing for a long trade. Once you get through the retracement zone, through the areas inside of it, you simply don't know if, when, or where the market's going to go up. The advantage isn't there. The pattern is no longer in play. So there are no entries taken in the KISS plan from beyond those triggers. This is where stops are placed. In a downtrend, it's the same pattern standing on its head. First it's momentum, then it's path. Large chart has got to do its job. Reversal bar begins the pullback. I know exactly where the pullback's likely to go using large and synthetic. This is my range. I need a line in there. I need something bouncy. There's my mid band, cranking through. Activate a limit order just below that mid band and sit tight. You've done everything you can do, and you'll never be in charge of whether it wins or loses, but you'll know exactly when to cut ties in that relationship, guys. When you get 4 to 5 ticks beyond, it's done. It's over. The advantage is gone. No trades are taken in the KISS plan from beyond the triggers. You'll learn to ignore every one of these lines because you don't know if, when, or where the market is going to continue down. I say pattern a lot. This is the pattern, guys. This is big chart, small chart, sitting side by side, holding hands, happy as they can be, with momentum and the potential to break. This is a market where the odds are favorable for it to continue up and where you can say there is room to get to trouble. And the market will be trading all the way up here. Your first reaction will be, man, there's just no room to make money. We've all done it. This is where the beauty of the methodology comes in. We're not trading from the top of the bar. This is where the pullback to the area inside of triggers pays dividends. The pullback to the area is right down here. See that tail? We're pinpointing where that tail is most likely to form using the refinement chart, which means when I take that amazing entry, I've got tons of room to get to my target. And because I waited for the pullback, I have the least amount of risk. And guys, all this is a pattern. It's a pattern from November. It's a pattern from 2021. It's the same thing. It's a pattern from 2022. Hell, it's probably a pattern from 9:30 a.m. Momentum, potential to break, pull back to the areas inside of triggers. We'll talk about it in a minute. Blew right through your stop, didn't it? Blew right through your stop, Adam. You gotta learn to respect these divergences. Not look for a higher entry. Realize that you're losing the momentum that you need to break that area. Does everyone remember when I said 2 triggers isn't your best look? The plan that I gave you to take that trade, Adam, wouldn't kill you. Says that the market must come from a strong top or bottom, which is that termination that reverses the market. You had that one. Says that your big chart's got to have momentum. You had that one. Said that your small chart needs momentum. You had that one. And then in bright red, no divergence on the 5-1. Divergence, a loss of momentum, is the biggest killer of that 50-50 trade. And then it reminds you before you ever get to management, seriously, divergence kills more of these than they allow to win. And then when you get to management, it says one more time, for the love of everything good in this world, if divergence prints, it's okay to exit that trade. So it also says 3 out of 4 trigger lines. So Adam, when we go back, and guys, this is the kind of feedback that you're going to get for the remainder of the day. We're going to go back and we're going to say, all right, you did have that strong top. That's pretty good. Momentum is awesome, but that's only one rule. The potential is there, but it's not the best potential. The divergence is there, which is a deal breaker. This entry is more likely to lose than it is to win. Does that make sense, Adam? And guys, this is what we're going to do. Once we get through the rules for TradingView, we're going to go back and forth with these charts. And Adam, one of the great things, and I'm going to say it's one of the great things because I firmly believe in this, and this saved me as a trader, One of the greatest things is that when you post in my room, I'm going to recognize the mistakes that you repeat. And Adam, this is your thing right now. Divergence on a 50-50 trade. And I'm not telling you don't take them because it's your right to do whatever you want as a day trader. I don't tell you what to do. Adam, I'm going to tell you that if I were training my children, the loves of my lives, the fruit of my loins, if I were training them to be a day trader, I would say, listen closely, children. If divergence prints on your two triggers through 50-50, medium probability trend trade, it's okay. I give you my blessings to insist on a reversal bar for entry. That's what I might tell my children, Adam. Now, seeing how you and I are probably the same age, you probably don't qualify as my children. But I'm going to accidentally drop this into the room because I don't give trading advice. But every now and then, I'll talk to my kids and explain to them the things that I've learned to find a little more success on trades like this. Guys, that's what we're going to do in the second half. We're going to go through, we're going to identify challenges, and then we're going to find a solution. We're going to find a solution to make you a more consistent trader. Are there any questions about the high probability trend trade? Guys, once you learn that basic pattern, once you learn those 3 simple rules, and once you believe that this is the recipe for the perfect trade, you'll begin to speak in terms of advantages when you look at your chart. And when you notice one of your advantages is missing, perhaps a clear path, because only 2 triggers are through, you'll lean on the idea of momentum. You'll insist on the perfect entry. And you will manage it 32 flavors of assertive because you know it's not perfect. And if you're looking at your charts and you're like, son of a gun, 2 out of 3 of my advantages are gone. 66% of the advantages that I hold dear to my heart are gone. That's low probability. You might get yourself into a position where you simply don't take it, where you say to yourself, as I said this morning, with weak triggers and no area inside of triggers, 1 out of 3 is not good enough for my money. Posted that this morning, guys. I took that, did my chart read, said, nope, 66% is not worth my pennies. And I skipped the trade and avoided the loser. It's hard to do that because it means you're not active. And we are the generation where inactivity is the equal to being lazy, right? How am I going to make money? How am I going to make money if I'm not active? You're going to patient and wait for the best. All right, guys. So that's Ninja Trader. TradingView is similar but different. TradingView is only 3 rules. TradingView is only 2 charts. Guys, I'm telling you, I'm not smart enough to make it any more difficult than this. Latch on to simplicity. There's a big chart and a small chart, guys. There's a 15-minute chart. That's your big chart. A lot happens in 15 minutes, guys. Those are huge bars that can cover ginormous areas. So 15-minute will be used for direction, momentum, targets, and terminations. Your 1 minute, your smaller chart, your faster chart, and guys, 1 minute's still a pretty good stretch of time. That's good, Victor. You don't have to do that while I'm teaching rules. I appreciate the Friday comedy, but man, trying to hold a crowd here. Your 1 minute chart, go play solitaire if you need to. Your 1 minute chart will define the immediate strength of the market, guys. You're going to define that retracement, that little fight against the trend. You're going to pinpoint where it's most likely to be lost. You're going to use this one for entries. Big chart, small chart. So we're going to go through indicators. Your big chart has triggers. Small triggers, that's it. No big triggers, no background colors. And guys, they're either up or down. This says cyan up, white down. I'm going to be honest. You could paint those any color you want and they would still just be up or down. Your small chart's going to incorporate the large triggers because there is the second trade on the plan that I gave you, and it's called the momentum trade, and it relies on that separation between the small and large, defining the immediate strength of the market. Both charts have areas. Areas are bouncy, even on TradingView. They can be used as targets, terminations, or entries, guys. I gave you the PowerPoint. I would encourage you to learn what are targets, terminations, and entries. And when I say termination, it means don't walk into a brick wall. That's it. Make sure you have room. So these 3 rules, I hesitate to call them 3 rules, guys. It's like having 2 rules because the first 2 rules are exactly the same. They are separated because there's 2 charts. You could put in all caps, just cover up the first 2 and just do this. Don't trade into stuff, right? Don't trade into things because things create bounces. Lines create bounces. 1-to-1s create bounces. Zones create bounces. Mid bands, outer bands, VWAPs, they all create bounces. Can't take a trend trade without identifying the trade. So what we're going to do is we're going to see which direction the market is going. We're going to make sure there's nothing in the way. And then we're going to buy or sell a pullback to an area, guys. We are literally going to let the market go up or down. Trend is defined by the small triggers on the large chart, the 15-minute triggers. If they are up, the trend is up. If they're down, the trend is down. This is the path of least resistance for new users. Is there opportunity going counter trend? Of course, there's always opportunities. But until you learn how to do it the easy way, going counter trend is a great way to drain an account. Once the trend is defined, you have to have room to targets on the 15-minute. You can't trade directly into areas. I had someone ask me once, what's the difference between trading into an area and trading to an area? Guys, into an area looks like that. I started my trade and there's nowhere to go. Trading to an area looks like that. From my point of entry, there's room to make money. If you trade directly into a line, it's more likely to create a bounce and ruin your good time. So make sure that when you enter the market, you've got room to get to that line. On the 1-minute chart, it's the same thing. Don't trade directly into areas. Making sure that when you take a trade, you have room to make money. Guys, this is one of the most important concepts. The whole goal of day trading is to make money. So if there's no room to make it, trading into lines creates a bounce. Trading into lines creates a bounce, creates a bounce, creates a bounce. If there's no room to make money, guys, you don't have to take that trade. You're not obligated. But if there is room on both charts, let's wait for the fight. So this particular picture, the large chart would have been going up, and the large chart would have had room to trouble. We need the small chart fight, guys. You'll recognize that the small chart fight is on because the small triggers on the small chart will head down when everything on the big chart says up. The moment that happens, draw a box around an area that's lower or higher and say, this is where the market has to come if I'm going to enter the market, because my rules say wait for the pullback to an area. Wait for the fight, guys. When you get there, there is one look that gets you into that trade. It's an up bar because we're going up. And both corners of the top of that bar must finish above the small triggers because the small triggers are the immediate strength. We want to get to the good side of it. That's your trend trade entry. It is, once again, a pattern. Push off of them. I like that, Ron. It's just a pattern. When the triggers are up, I choose to go up with them. My plan, the KISS plan, says I have to go up with them. When I have room to trouble, watch this. If the market is trading into trouble, my journey is over. That's it. Don't care about the small chart. How's that for dramatic? But if I have room to targets, then and only then will I go to the small chart and look for my entry. And the pullback, because my rules say buy a pullback. If there is no pullback, it's not a trend trade. I have to wait for it to start down. Small triggers roll. I'll put a box around a lower area and say, come get me. And when it gets there, it's the up bar that finishes above the small triggers. That's my entry. We did that yesterday in the room, I think, where we put a box around an area and said, okay, here's our trade. And it was like 13 minutes before it got there. But when it got there, the area in the close above reversed the small chart in the direction of the large chart, and it was pretty easy profits. So when the triggers are down, when there's room to trouble, when the small triggers turn against me, the fight is on. Here I go. I know exactly where it has to go, and I know exactly what I have to see to enter a down bar that finishes below the small triggers. Guys, this is your pattern. This is the trend trade. This is the foundation. This is the look that is repeatable. Look at resistance holding. Welcome to Friday. This is the trade that you can prove wins more than it loses. This is a trade that creates patience. The triggers are up, but I'm in a zone. I can't go long or short. I'm stuck in purgatory. That's what these zones are. And when you get in zones, you start to see consolidation. Rule number 1 isn't met. I choose not to go to rule number 2. Guys, be patient. The market moves a lot. Triggers are up. From where we are, we do have room to get back up to trouble. Here's our pullback to an area. Now all I really need is a close above those small triggers, but I have to have room to make money, and there's a couple 1-minute areas in the way. So once again, I'm probably putting my patience hat on and saying, you know what, it's not the perfect look yet. Not the perfect look yet, but I'm getting there. Tesla Nerd, just wanted to say thanks for doing this daily. Without it, I would not have passed my account. My OCD self found a combo that works, and without sounding creepy, your calmness and teaching kept me focused. I appreciate that. The repetition of the rules stayed with me. I appreciate that, Tesla. That is my goal each and every day. I want you to take those winnings from the $100,000 account, and I want to see a client check mark next to your name. Keep trading well, man. Keep trading well. Guys, that's it. That's my first hour every hour. And like Tesla just said, and seriously, thank you for that. It's the same hour every day. It's repetition. Repetition creates recognition. It's easy to chase trades, right? It's easy. Let me show you how easy it is to get in the market. I'm in the market. That's it. That's how easy it is. But am I in the right trade? Am I in the trade that I can prove wins more than it loses? Am I in the trade? Look at that. Pull back to support. There it goes. Maybe those trigger lines don't lie. But what I'm saying is, it's that relaxation, that calmness, that I don't care what the market does because it's going to do what I need it to do eventually. Eventually, the market's going to give me everything that I need to find success. Eventually, the market is going to give me an entry. And eventually, the market is going to get to my targets. And guys, this is a game of longevity. This is a game of doing, whoop, there goes. This is a game of Ninja Trader crashing. This is a game of doing the exact same thing every time you enter the market because you have proven beyond a shadow of a doubt that it creates an edge. So Tesla, until you become a client, I want you to do me a favor. And I don't know if I'm allowed to do this. Go to Trustpilot. Tell them how much you enjoy the education. One of the things that helps us out as a fledgling company, and Pro Trader Funding are those Trustpilot reviews where you guys say, oh my gosh, these guys really do give a shit about us. These guys really do take care of us. They take care of our tech problems. They take care of our questions as fast as they can, as accurate as they're able. And this is for all of you guys that are using the funding company. Get in there, rave for us a little bit. That's like the, oh my gosh, let me help out Nexgen because I appreciate what they've done for me thing you can do. I don't know if I'm allowed to say that. I may get a call from my brother saying, the hell are you doing? You can't solicit that. I feel like we can. I feel like we've earned it. All right, guys, that's my first hour. Are there any questions? Are there any questions about momentum? Are there any questions about path? Um, awesome. John's pretty cool. I hate to admit it about my brother. He is so customer service oriented. And I have seen him break his back bending over backwards for people that probably don't deserve it sometimes. Most of us don't when we're angry. We let it get away from us. So I appreciate that. I really do because it means that we're hitting the mark, and that's really the goal. So I'm going to take a break. And guys, remember, short class. So we're going to get back and look at charts. We'll do a little bit of chart reading, but we're busting out of this joint by 11 a.m. I've got a 6-hour drive ahead of me. Um, I got to go pack some golf clubs so I can take a beating down in Sarasota. So go stretch your legs real quick. I'm going to high five my wife. I will see you in about 3 or 4 minutes, guys. We'll come back and look at all the charts that you guys have posted. Sergio, it's going to be 71 and sunny tomorrow in Sarasota. I'm okay with it. It was 21 here. 21 here this morning. 42 is not so bad. Jeffrey Dean, my boss, said get in the car and get to Florida. I'm a victim here. I'm a victim of the man. I mean, it's a plan perpetrated, keeping me down. So, Ninja Trader's coming up, guys. I'll see you in 5 minutes. 27 in Panama City. I'll high five you when we drive through. I think we go right through Panama City, or real close on the way down there. Back in 5, guys. All right, guys, here we go. 46 in Arizona. Things you don't hear that often unless it's the middle of the night in the desert. Um, I'm going to click on the pictures that are posted, and we're going to talk about what you guys posted. And that's kind of just how the room works. Um, and Paul, I think there's a good lesson there in your picture. We already talked about it a little bit, but we'll do it. Not a ton of pictures this morning. We got a couple. Um, Victor, Adam, I think we already did the lesson on yours. We could probably skip that one. And Lawrenceville, Georgia. I lived there, Victor. Lawrenceville. And guys, just a little FYI. Don't go out for sushi in a 43,000 person town in southern Georgia. Just throwing that out there. It's a bad idea. Not so good. All right. Triggers are down, so the trend is down. And he's got all the room in the world to trouble. And then, Paul, this is where language pays dividends. And guys, I really am. I'm a total language nerd. So the language says, and large chart's great. The large chart says that I am going to sell a pullback. Again, I'm going to go to the language. Add an area. Then take a close below the small triggers for entry. And guys, if you learn this little bit, what you find is that incomplete thoughts, incomplete rules, partial rules rarely work. So, and you said that this zone wasn't here at the time, right, Paul? We didn't have a zone in play. And that'll happen. When you take a picture after the fact, it may shuffle a little bit. But the challenge on this one, and I'll just go to the picture that I drew, is that there was no area for entry. There was no bouncy stuff for the market to ricochet and continue down with those large chart advantages. And what happened, Paul, is the zone came back later because clearly somebody knew about it, right? They worked its way into the supply and demand. But one of the things that you'll find is that without that pullback to the area, very often there's a shuffle and they go up. And look, it looks like they went right to the mid band and then they closed below the small and then they continue down with a large chart. So the lesson here, TradingView users, pull back to an area. Pull back to an area. Get to an area. Hit something bouncy because it will try to head fake you. Let's see. Pull back to an area. Close above. I thought I had the same picture that I used in the slideshow. Hold on. Maybe it was that one. No, I don't know. Good lesson, though. Great picture. Perfect read. You just got tired of waiting. And yesterday, Paul, you asked, hey, can I pull those 15 minutes over and use them for areas? And I said, you can do whatever you want. But there's a reason that the plan's written the way it is. And it's based on hundreds of hours and thousands of pictures. And if that were where your advantage came from, I would have put it in the plan, right? So just because it didn't work once doesn't mean it's not going to work every now and then. Does it create winners more than it creates losers? That's the question you have to ask yourself. My research said no, but sometimes we got to figure it out on our own. What part of Colorado are you in, 10K? I do love some Colorado. Terminations reverse the market. Denver, right on. You don't have to sir me. I was in Lafayette for a year in my 20s. Drank a lot and snowboarded. Good stuff. Guys, all the momentum in the world. Only 2 triggers through. Pete takes a momentum style jump the fudge in trade, and it just doesn't work. So he takes the trend trade. And does everyone notice 2 triggers through? Not the best look. divergences, and look how high it pushes, guys, all the way up to that fib and 1-to-1. And Pete said, I'm going to give it a shot. I'm going to give it some breathing room. And probably got a little sweaty in the palms. And sure enough, it did everything that the large shard said it was going to do. And then, Adam, do you remember when I said, if there's divergence, the conversation that I had with my children in front of all of you guys, if you get divergences on that 2 triggers, look, it's okay to demand a reversal bar. And think just for a second the difference between getting in at 10 and getting in at 775, right? That's a huge difference. It's still a good looking trade. But okay, so Adam, right now in the moment, goldfish brain, right? See how if you waited for a reversal bar, it still puts you in the short. There was practically no risk. The large chart didn't change a whole lot. Everything is still down and cranking. I'm telling you, sometimes it's better to confirm than predict. Sometimes it's better to confirm than predict. You'll have to decide what works for you. All the momentum, nothing in the way. Jump the fudge in with momentum. Get paid because it's just momentum. Great trade, Pete. And I was telling Pete earlier in the room, man, that was an awesome hold. It was a scary hold, but it was an awesome hold. That's all right. You got it. It's repetition, Adam. It's doing the same thing every time. And remember that what I teach, let me see how I should do this. So what I teach, you have this blank slate, right? And this is your high probability trend trade right there. That's the epicenter. And then from that high probability trend trade, you've got entries and you've got management, right? And these are very basic. And then as you grow with the software, as you begin to grow, you get these little satellite concepts that come. And I don't know what I'm going to turn this into. But this is like 50-50 with divergence. And this is a second higher divergence. And this is, I don't know, waiting for the small triggers to roll continuation. They're all derivative of the high probability trend trade. And when you figure out the basics, oh man, it killed me, smiley face. When you figure out the basics, right, this is the best. And then there's these little nuances. So you're in this constant state of growing. And until you just get pretty solid with it, there's always something new to learn. So you got really good at entries, being patient, waiting for the best entry. And now you're starting to learn that there are, in fact, variations on your entries. I'm not sure who this is, but it's a lot of momentum. And it's nothing in the way. And it's a pullback to an area inside of triggers. This can't be Pete because Pete would have an entry somewhere down here too. Just kidding, Pete. That is the perfect trend trade. That's about as sexy as it gets. I love that. And this is what I like even more, is you got in at 94, get paid down at 01, and now you're back in at 95 to double dip. That's good stuff, man. Great looking trend trade. And sure enough, it works. Typically 70 to 80% of the time. Pete, you got paid twice in this range. People say, how did he make all that money? Well, because he knows that base hits pay bills. This is your weekend homework. You guys ready? Go watch Moneyball. If you've never seen Moneyball, invite your wife because it's got Brad Pitt and he's dreamy, right, Trina? Go watch Moneyball. And the whole concept is get on base. Get on base. Base hits, right? You don't have to be in up here and out down here to be successful. There's so much money to be made if you just learn a couple patterns. Sorry, Trina, I looked up and I saw your picture. And I thought I should probably at least call on one of the ladies in the room when I mentioned Brad Pitt. Guys get weird about that stuff. I'll say it. He's a pretty man. Not my type, but he's a pretty man. 15 minutes down, all the room, pull back to the area, in below, and man, they just didn't make it, did they? Just didn't make it. Did they ultimately make it? Paul, who is this? Is this Paul? Did they end up making it down to 25,829? And I'm curious why the exit. And sometimes it's just a number, right? It's 7:15 a.m. Let's go look at the NASDAQ. 7:15 a.m. So it was right about here. Nope, that's the S&P. It's going to be hard to find the NASDAQ trade on the S&P. So did they make it to 25,832? That's the question. It's 7:15. They most certainly did, didn't they, Paul? They made it to your target. So now you have to ask yourself, why the exit? With nothing in the way, why the exit? With the large triggers rolling over, with the small triggers below the large, what scared you out of the trade? And guys, this is management, because it definitely made it down. It made it down, I think, almost to the mid-band there. One of the hardest things you'll ever do, and one of the biggest advantages of simulator, is let it play out. Right, Sergio? Let it play out. It's simulator. Just watch it. Put your hands on your head and say, man, I took the perfect entry. Let's see what it does. This is simulator. I'm playing video poker that didn't cost me a penny. I'm betting all in every time. And then I'm going to see what happens. And guys, if you get in that habit, what happens is when you do actually go live, you come at it with a confidence. I've seen this trade so many times. I've watched it win more than it loses. And more importantly, I've allowed it to win more than it loses. And that's where you get there. So when you make that transition, life gets a little bit easier. Triggers are down, room to target, pull back to the area, close below, and there's the exact same trade. The exact same entry, gentlemen. I love this lesson. And this is a hard lesson for most of us in the beginning. I want you guys to learn 2 words to piece together. You ready? What changed? So from my time of entry, what changed? Well, my small triggers started working below my large triggers. That's a good thing. And then my small triggers got below my large triggers, and that's a good thing. My large triggers started to roll over. That's a good thing. They actually rolled over. Holy shit, that's an even better thing. The market retested resistance. That's okay. Resistance stops things. The market gave me another short signal. That's a good thing. And then everything rolled, and it did everything the indicator said it would do. And if you go through it as you take a trade, what changed? Talk about the good that's transpiring. Talk about the positives that are showing up in your trade, and say things. With these triggers down, with room to trouble, all this area of resistance is another opportunity to go short on a pullback, but I'm already in the pullback. I feel comfortable. I feel confident. That's hard to do, especially when the market's going sideways. Have I ever mentioned the what if monster? When you take the perfect trade, the what if monster will sit on your shoulder and say, Sergio, what if it reverses and takes all your money? Trina, what if that momentum and everything, all the room to targets, isn't going to work this time? Don't you want to jump ship? What if the sideways bar movement means that you're about to lose. And guys, you'll change your strategy mid-trade. Know exactly why and where. You'll exit that trend trade and learn how to die on your sword a little bit. Sun Tzu used to say, you have to put yourself in the kill zone to be victorious in battle. Everything says down. Pull back to an area. Close below triggers. Easy money, right? It's easy after the fact. I wasn't in this. There were absolutely no nerves. But this is good because it did everything the indicator said that it would. Good stuff, Paul. I'm not sure you're still in here. Trend trade. But it feels like I jumped the fudge in. So let's see. Strong side. Room to targets. 240. Yeah, you just jumped the fudge in. That's all you did. Victor. So remember on your last photo, I want you guys to see something. This is kind of cool how this works out. On your last photo, you took the time to say the market reached it and this is resistance, right? Because this supported the short that you wanted. And I think that's cool, guys. And what I'm talking about isn't knocking them around, but this is an observation that you guys will notice in your own trading. Here, price reached resistance, and it's the exact same look, but here you took the trade anyway. This setup, you had room to trouble. That was your pullback to support. Could have been in down here on the HVA. And then it hit resistance, and it came back and retested support. And then it hit resistance, and then it came back and hit support, right? So rattling around, caught in a cage. I'm going to show you how great this trade is, Victor. And you probably already knew it. And then Victor says, wait a minute. They're fighting, and the whole time they're fighting, Victor, what changed? Well, the large triggers kept going up. The small triggers stayed above the large triggers. The large chart kept pushing higher. Victor says, I know it's not a trend trade, but this is my breakout look. This is my triggers. Everything says up, right? I'm going to say, based on everything my indicators are telling me, this area is more likely to break and the market's more likely to continue up than resistance is to lose that fight. Because every time resistance fought, the triggers kept getting better. Did you notice that as you were looking for the breakout, Victor? So yeah, you did just jump in, without a doubt. You also jumped in on the bar that gave you a complete bar above the resistance, which turned it into support anyway, which is bonus. But it's a great patient read. It's like, don't know, not sure, oh, but they're still fighting. But look at how the market keeps that pressure up. I like this one, Victor. Not a traditional trend trade, but a good usage of the chart read for the breakout. I like it. 10K, this is called Chart Prime. So Chart Prime is they're a third party. There we go. I'll give you the link. They create these areas of supply and demand. They're pretty outstanding. I think it's $50 a month. And you'll see that most of the people in here on TradingView are using that. All right. Oh, and that's the one. That was just one of the pictures that I put in there. Good stuff this morning, guys. Victor, I really like the breakout trade, not going to lie. And you were right in saying it's not a traditional trend trade, and that doesn't mean that it's wrong, right? Which is the cheaper of the two, 10K? Sorry. You don't need the expensive one. You don't need the expensive one. And they do a demo, I think. And most places, when they do a demo, will send you an email and offer you a discount. I like that, Victor, because you were thinking about it. And it's fun to go through it and um, talk about what the indicators say about what you're doing. I think that's a great tool in the class because what it does, and even if you're not at that level yet, guys, what it does is it lets you know that the market's telling you a lot more than you know as a brand new user. The market's giving you a lot more information than you realize, and the more you slow down, the more you'll recognize that. All right, so two good lessons on this one, guys. Here's the first lesson. And I don't know if I've mentioned this at all today. Um, Potential to break, divergence is typically a big killer. Um, with that entry, your risk was next to nothing, right? You could justify that. But here's the best lesson, I think, and it took me a while to learn this one. So you are one tick off of Fibonacci resistance here. And then Adam, did you recognize that it was a weak bottom? And that's rule number one. Because what happens so often from a weak bottom? That downtrend tries to push up, can't really break the areas, and very often we see continuation. That weak bottom is a little bit of a red flag on a 50-50 trade. But here's one of the cool lessons, and I remember John talking about this when he was starting Nexgen. And John Novak used to, every morning, him and a gentleman named Jerry, and I don't know why I remember Jerry's name, but him and a gentleman named Jerry would open up their charts, and I don't believe it was NinjaTrader at the time, and they would take their Fibonacci retracement tool, and they would find one pivot, and they would do the math, and they would write it down, and then they would say, okay, now we've got kind of a bigger pivot, and they would write down all the numbers and they would see, okay, from these two measurements, where do they line up? That's a good spot, potential support and resistance. Man, what an arduous task, right? If you've ever met John Novak, you realize that he is very much a work smarter, not harder kind of guy. So he said, this is some grade A baloney. I'm going to automate this shit. Pardon my French. Friday swearing. And he did this. Let me find my picture. I lost my picture. Hold on. 101 classroom. There it is. All right, guys, here's your birds and bees lesson on Fibonacci. When you open NinjaTrader, your software measures every retracement, every pullback, every up, every down, every pivot. And it does it on that 13.2 chart. And it does it on that 5.1 chart. And it does it on synthetically created higher time frames. And it does it forward. And it goes back historically like 10 days. And these are all of the calculations that your software is looking at when you open the system. Thousands of calculations from thousands of pivots. And then this algorithm kicks in, and it's the John Novak smart stuff. And it weighs them, and it sorts them, and it goes through these parameters of which are the most important, and where's the highest concentration. And from all of those calculations, you get this red fib. So, Adam, if I am one tick off of a fib and divergence prints, that's typically good enough for me, especially if these areas haven't broken yet, especially if it's from a weak bottom. Does that make sense? So I hate to say it's horseshoes and hand grenades, but if you go back and look, and it's not horseshoes and hand grenades, that doesn't do the software the justice that it deserves, you'll notice sometimes it goes a few ticks above, right? And you'll notice Sometimes it does go a few ticks below. Guys, that's insane accuracy. It made it 7 or 8 ticks above. It came back and retraced 4 ticks below. So while we always want to see it go a little bit beyond, right? Or a little bit below, because then we actually get to our target. When it's that close, and that was not, that was S&P. Maybe they came back up and retested it, but I think that's a good lesson. I really do. The momentum is outstanding, but it's only 3 triggers through, Adam. At the time of your entry, look at where that other large trigger is. Do you see it? It hasn't broken this support or this support, or well, I guess at the time, it hasn't broken this resistance. It hasn't broken this resistance, and it hasn't broken that resistance. So you've still got 3 triggers below. 1, 2, 3. 3 areas that we're hoping breaks. Does that make sense? And I'm not sure which line you were looking at to say 4 triggers, but at the time of your entry, these were all the way down here. So divergence is a little bit of a red flag, without a doubt. Weak bottom, a little bit of a red flag. Per entry rules, it makes sense. And then when it bounces off those small triggers, that 1-to-1, can't continue, great exit. Great exit, Adam. But some good basic chart reading lessons in there. And I think it's important to remember for everybody that what I teach, look at that, momentum, only 2 triggers through, right? But it is from a strong top. Strong triggers, strong triggers. It's almost 3 triggers through. Where's the market most likely to bounce if they make it? Excuse me, I'm so sorry. Just below Fibonacci resistance, right? Wouldn't that be the spot to see if they want to make it to the fib? I don't know if they're going to get me. They might. I don't know if it's going to win or lose. It's only a medium probability trade. But with the strong top, I like my advantage. With all the momentum, I like my advantage. With only 2 triggers through, I'm a little bit nervous. I may not let it get that far beyond the triggers. I may insist that these areas hold. I'll keep it much lower risk because it's only 2 triggers through. If it goes, fantastic. If it doesn't, it's a little hicky on the basics. But guys, from a strong top, they're probably trying to get to that fib, right? And with this being a weak bottom, they know about that fib. But now you're watching them make decisions right at key areas, and it's either going to win or lose. But with 2 triggers through, it's more likely to lose than win. There you go. And that's why the KISS plan says 3 out of 4 triggers. I like taking these so that you guys see that there are challenges in the market, and they're very similar, so you got to learn the subtleties. And until you can, there's a very basic plan. Trend trade, triggers down, room to trouble, pulls back to the area, closes below. You're in at 45. You're out at 33. Great trade, Papa. Great trade. And I like that you didn't get in here right into the zone. You actually let it start to roll down and get below, so you're not fighting the triggers. It's a little late on the entry, but it's a good patience. Good patience. Third zone, third close below small triggers into a zone. That did well. Very, very well. I'm keeping a record. All right. You know what your record needs to be, Paul? You're going to like this lesson. As price pulled up, what did it reach? It reached resistance, right? That's the rules. Pull back to resistance. Can you guys hear me? I hope so. You never get that break above, do you, Paul? You never get that full body of the bar above it. It's still resistance. So that's a close below at resistance, and that's a close below at resistance, and that's a close below at resistance. Now, if you got a breakout bar, it becomes support. The same way, when it broke above this area, it became support. And look what it did. It created a bounce when it hit it. Does that make sense, Paul? So if the trade says from resistance, these qualify. They're a little unorthodox, maybe kind of next level. But ask yourself, what am I trading from? Am I hoping that support no longer becomes support, or am I hoping that resistance stops the market the way it has? Does that make sense, everybody? And again, we're going a little more advanced today. We're going a little more, diving just a little bit deeper. Where's the market trading? Right there, into support. Still support because it never broke above, right? This was support, became resistance, and over here, the market pulled right back to it as resistance. So being able to name whether the zone you're looking at, whether the area you're looking at is actually support or resistance will help you make some decisions down the line. All right. Adam, 3 triggers just passed. Termination. Yes, I saw the divergence and waited for the reversal bar for entry. And then made some money. And managed it. Adam, pretty cool. You got the same entry, didn't you? But now you had some place to put your stop. You had the confidence the market was on the good side of the triggers. And then that second higher divergence is a great exit. One of the things you can do, Adam, and let me ask, would a second higher divergence be an exit condition for you? Or do you just go break even and hope for the best? And neither one's wrong. Some of us have rules that say second higher divergence, I'll exit that trade, especially on only the potential to break even at the first target. Okay, so you take all management off and just let it either run or not run. Let me show you something cool. You may like this. And let me ask. So a second divergence on the potential to break, not at all a red flag for you. You'll just say, man, I'll hold it. Let's go. That's like a ginormous red flag for me. And that's just me. But I've been doing this for a while. Because one of the patterns that I recognize is when I get a second higher divergence, very often there's a much higher push. And it's not always a trend killer, not always a trade killer, but one of the things that I do in my plan, and I'm just sharing my own worldly advice with you here, is I will exit that position with the full understanding that if I get a reversal bar in the direction of my trade, I'll simply re-enter the position. And what I have found in my world is that has saved me an enormous amount of money. And I've got it. Something to read over the weekend, if you choose to. I'm not going to make you. Second divergence. If I get a second lower divergence, I'll exit. I'll take those profits because there's a good chance it'll push lower. And if it goes back up, I'll go back up with it. And if I get that second divergence, oh, this looks just like yours, and I never get that signal, I've taken profits, and I don't lose that trade if it does decide to push up higher. And I think that this concept might prove to be a pretty awesome management tool for you. with those medium probability trades. I hope that was helpful. Trend is down. Strong side of the triggers. Room to targets. Do you not see the divergence? Divergence isn't on your radar, and that's okay. Let me figure out what you did here. Pulls back to the area. White bar closed, but no room to targets. It pulls back up. Good save. So you did trade directly in, and then it stopped you out. Is that right? Got in here on the way down. 10 seconds left. Didn't follow the rule, and it spikes and gets you. And then it broke the zone. And then you catch it on the pullback to the zone. And you're out. And you're out. I don't know. Is that another buy? Is that a buy? Or is that you getting flat, Wayne? Maybe on these. Check it out. Maybe on these, Wayne, if you wanted to. Since that's all that I need of a large chart, right? Large chart's pretty simple. Give us a little breathing room over here. Like, just to see, because I love your trades, but man, it's like background noise. It's hard for me to take all these bars so close together. And I think maybe if your entry chart where everything is happening, we lost 6 inches of large chart, it might make for an easier read. So that's getting flat. I love it. Great target. And then it pulls back and all the rules are still met. And you say, let's go again. I love it. Right back down. That's one of the cool things. And that's one of the big differences between NinjaTrader and TradingView is NinjaTrader says no more shorts. TradingView says, dude, these bars take forever to do stuff. If your rules are met, if you have room, giddy up, brother. Have fun. And Wayne, you do that really well. Nice job. And I hope it doesn't sound like I'm being a crybaby about the way they read. I just think there's an easier read. Counter with aggressive stop. Counter's hard. But let me show you something cool, ladies and gentlemen. Boom, 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 boom. When this is your normal, and Wayne, I think we could agree, this is your normal. Little counter trend trade every now and then, taking that aggressive stop placement, taking a shot based on a pattern to be the first one in. Every now and then, you're like, I know that this could lose, and I'm willing to risk the $480, but if it really is the bottom, it's money. And when you're consistent in your trading, guys, and when you have a plan, and when you focus on the easy trades, 120 per contract, that's not so bad. When you focus on the really easy trades, you put yourself in a position, whoops, where you say stuff like, boom, 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 we're at a bottom, right? The pattern hasn't printed. We've reached a termination. We're at an outer band, and I know that it's counter trend, but if I get some rules for a long here, man, I'll give it a shot. I'm up $5,000. I'm up $2,000. I'm up $1,000. Maybe I'll take that trade, but only under the best of the best scenario. And John and I always laugh. Counter trend trades look amazing when they work, and they look absolutely ridiculous when you get run over. And my rule is if I'm going to go counter trend, I'm going to go counter trend once. I'm going to take the shot. If the shot doesn't work, I'm done. That's it. Everything's got to roll and put me in a good trend trade. So I'm not opposed to the occasional counter trend. Awesome, Wayne. Have a good one. My work's almost done. We're Sarasota bound. Great trading. Good stuff. All right. 2 out of 3. Told you guys they were looking for the fib from the bad bottom, right? 2 out of 3. Let's see if we can get 3 out of 3. Or 3 out of 4. There it is. There's 3 out of 4. It's all the momentum. I've got strong triggers on both charts. They started at a fib. The only thing I need at this point is a pull back to an area inside of triggers. And I need there to not be divergence because divergence breaks my rules. And I'm not breaking rules anymore. We did it once for grins just to see if it would actually lose. And it did. So here's what I have to do. I have to watch this. And if divergence prints, I have to cancel my order. The 1-to-1s are fibs too, correct? Dynamic fibs. 1-to-1s are 100% Fibonacci alternates. So they are fibs. Let me see if I can find a good picture to show you how these are born. A to B, B to C. Okay, so this is a good picture. This is about as techie as I get, Phil. So the market comes down, the market goes up, the market comes down. I think this is, and someone told me Jerry was Elliott wave, right? So this is your A pivot. This is your B pivot. I think I'm doing this wrong. C pivot. So I probably screwed this up. What 1-to-1 alternates do, Phil, is they measure and they show these yellow dots. It's like the same distance on this pivot. So if you did like an exact, it should be pretty much the same size. And I think it is. So it's a 100% Fibonacci alternate, and the institutions, they use these. So that's why you'll see them print and then stop printing. Because when you don't need it anymore, it doesn't print anymore. So this went down and up, and then the distance from here to those 1-to-1s is the same distance as from here to here. They're measured moves. Thank you, Jerry. I remember the lesson, kind of. Kind of, right? Now it's tail end of momentum, all the path, and no areas inside of triggers. But that's what they are. So, Phil, if you see a 1-to-1, it's a fib in the moment. It's a in the now fib, if you will. That's one of the reasons they're so stinking powerful. Because it's the easiest Fibonacci retracement you could ever do. So guys, tail into momentum. Nothing but room. But my areas are on the wrong side of my triggers, which means that my rules say I can't take a trade from up there if I'm following the KISS plan, because once I get above these triggers, I'm not sure where it may stop. Was thinking it'd be nice to have all the extra fibs. Man, Phil, they tried. We tried 100%. Have a great weekend, Miss Trina. Thanks for being here this week. And thank you for all of the posts this week and the great lessons for everybody. Thank you for that. And there you go. John says they will not allow it. They will not. They know, and they won't. But you can make your fib lines as horizontal lines. Takes about 2 minutes to plot them on TV manually from Ninja. So what John is saying is you could bring up TradingView and you could go to your S&P and you could say at 69.78 I have a fib. Boom. Fibs on Ninja. Might have a hangover, but not an off day. So that's one thing you can do. Phil, You could also just look at NinjaTrader, right? And if you're executing on TradingView, you could just go up. I know there's a fib there. No, it's full day, John. It's full day. Nothing's closed. Nothing's different. We checked it the other day in class. One of the things I like to do, Phil, and I do most of my trading on NinjaTrader, is I'll look at TradingView and see what direction those big 15-minute triggers are going. And what I have found is that when I fight them, I tend to lose. And when I don't fight them, I tend to win more than I don't, because 15 minutes is a huge honking chart. One of the reasons the KISS plan says don't fight them. They really are. And I use that. I showed Jen a picture earlier today. I use those 15-minute triggers. If I have the gap theory in play, and the 15-minute triggers are in the direction of that gap, I am more inclined to take that gap trade. I don't take them very often. It has to be the perfect mix of everything. Monday's MLK market. No, Jerry, it said that they weren't. Oh, John's giving us CME MLK day. Interest rates, Monday. Pre-open at 12, open at 5. Maybe they are closed. I may have read it wrong. I never know what they mean on these. They open at 5, open at 5. So they open at noon on Monday. Is that right, John? Am I reading that right? On Monday, 12 pre-open. U.S. federal holiday. Expect early closures or altered trading hours. Many future. Well, I just Googled that. That doesn't give times. Does 12 pre-open? Is that AM? Or is that noon? I guess 12. It looks like they're on military time. So that would be midnight, pre-open. Tuesday? I don't know. Feels like math. I don't appreciate it. Friday, Tuesday, Monday. All right, so they stop at noon Central. Close on Monday for most futures at noon. No lumber. How am I supposed to run a classroom without lumber charts? That's messed up. Lumber futures are where it's at. All right, guys, so check it out. They went down. They hit support, and they're bouncing right off support. And then, Adam, just to get back to the lesson, they did make it a couple ticks below the fib, right? But that divergence lets me know they were pretty serious about it. Hit support. 1-to-1s. I didn't miss it, Pete. We talked about it. We talked about that one. We talked about that one. Didn't take because in my experience, if a pullback comes from a termination area with divergence, it is much less likely to hold. I tried to trade advantage in probabilities, not possibilities. Yeah, I'm calling bullshit. That's not a termination though, is it? It never reached anything. It's the perfect trade. It never reached those 1-to-1s. That is a high probability trend trade with one divergence. I would lose that one all day long. Woodworth. No. No. Are you ready? Oh man, lesson time. So Fibonacci. Oh, Fibonacci. Fibonacci is a mega conglomerate of thousands upon thousands of calculations. So sometimes close enough, a tick or two, is good enough. Fibonacci, a 100% alternate, is exact. It's the number. Same thing as like a divergence high or a divergence low. It is the number. It's not an area in the sense that there's a high or a low. It's a number. It's to the tick. And you were still a pretty good ways off of it. This is honestly, Pete, it's just a great trade that didn't work. It worked out great for you. But I probably would have taken that one right at 94 and gotten stopped out around 95. Not felt bad about it because I had all the momentum and path on the large chart. That's a pretty solid look. You think? Yeah, it's super low risk. But if you're really letting the large chart lead, that's pretty outstanding. And they just, I don't know, somebody, that's the thing, right? Sometimes they just want it to go the other way. Sometimes they don't want to make the target. Sometimes somebody with a lot of money has something else in store. Was that the S&P or was that crude? That was the S&P at 741. Let's go look and see what they did. I like doing this. I like backtracking. And look, Pete, bad bottom. They finished the move. Pretty freaking cool, right? Right to the mid band, nothing blinks, finish the move. And then Upsville. That's awesome. That's a good lesson, I think. And honestly, Pete, we're going to go ahead and put this on a calendar. This is one of the times where not following our rules pays dividends. You avoided one of the 20 to 30% by deciding you didn't want to take that trade. But then the market did everything that it would suggest. Bad bottom, finish the move, right? Bad bottom, finish the move. Bad bottom, finish the move. Over and over. It's crazy how often that happens. Bad bottom, boing, finish the move. It's a pretty cool pattern. Sorry I missed it. You know I never miss them on purpose. Sometimes I get to clicking and there's a few extra links in there and I just miss it. That's where my wife would go, oh, you're so pretty. All right, guys, it is 11:48 in the a.m.